Welcome back to Investing Talk podcast.
Today we're looking at Rocket Lab.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone who's been tracking the commercial space sector, Rocket Lab has, sort of been the quiet, steady performer.
Right, but their recent Q3 results, they were anything but quiet.
Exactly. The results and some of their strategic moves have really made people sit up and take notice. So today, we've pulled together the whole story.
So we're looking at the financials, the acquisitions, the technicals, basically the complete picture of where this company is headed.
That's the plan.
And I think our mission here is to figure out if Rocket Lab is actually making that leap, from being a promising startup to a truly dominant, profitable player in the space.
Because that's the real question, isn't it?
It is. I mean, you see a headline like they're trailing 12-month revenue jumping roughly 78% year over year. That's huge. But we need to know what's really driving it.
And if it's sustainable. That 78% jump, putting them over $500 million in revenue, is definitely striking. But let's zoom in a bit.
Okay.
The most recent quarter, Q3 2025, brought in a record $155.1 million. Now, that's a very strong 48% increase year over year.
48% is still fantastic growth.
Oh, it's excellent. But it does show the rate of acceleration might be cooling just a little compared to that massive TTM spike.
And that's where the context really matters, right? Is the momentum slowing, or is the foundation just getting broader and stronger?
That's the perfect way to put it, because the story we're seeing is that the launch segment, while still growing, is maybe stabilizing a bit, while their higher margin businesses are really picking up steam.
And that shift, I imagine, is where you see the path to profitability.
Exactly. You look at their profitability trends. They are still posting a net loss, which is, pretty typical for a scaling aerospace company.
Of course.
But that loss is narrowing materially. Their guided Q3 EPS loss was just 6 cents.
So every quarter, that gap is closing.
It's closing. And that continuous narrowing signals they're getting much better operational leverage. And for investors, that's really what you want to be focused on right now.
And when we talk about leverage, we have to talk about margins. That was the most impressive number for me this quarter.
It was an incredible number. Their gross margin climbed to between 39 and 41% in Q3.
In a sector where launch services can feel like a commodity, hitting 40% gross margin that's a huge competitive statement.
It is a massive indicator of efficiency and, more importantly, pricing power. Many competitors in this space are scraping by with margins in the teens.
Or even lower.
Or even lower, especially on complex missions.
Yes.
So for Rocket Lab to hit 40%, it suggests two things. First, their manufacturing for the Electron rocket is just top tier.
And second,
and this is crucial, their space systems division, the part that builds the actual satellites and components, is driving a ton of high-margin revenue. That margin performance is the strongest argument for any bullish outlook.
It also gives them that financial flexibility, which is often the Achilles heel for these high-growth, capital-heavy space companies.
It really is. Looking at their balance sheet, they are sitting on a serious war chest.
Liquidity surged recently.
It did. They've bolstered their cash position significantly, now holding almost $808 million in liquidity. A big chunk of that came from recent equity offerings.
And you have to think of that liquidity not just as cash on a spreadsheet, but as insulation.
It's competitive insulation. That's the key difference. While some of their peers are frantically trying to raise cash just to survive, Rocket Lab has this flexibility.
They can fund their R&D for Neutron. They can make strategic buys.
Without the immediate pressure of a market downturn. It lets them play offense.
And they are absolutely playing offense, which leads us right to their strategic growth and how they're building out that competitive moat.
Let's talk about the Geost acquisition. That finalized back in August.
Right, for around $290 million. This wasn't just buying hardware, was it? They bought intelligence.
It was purely a strategic capabilities acquisition. Geost specializes in advanced space-based sensors and observation tech.
So why is that so important for them?
Because it dramatically enhances what they can offer to government and national security customers. They're moving up the value chain. It's not just about the ride to orbit anymore.
So it's about becoming indispensable to those high-spending customers. They provide the launch vehicle, and now they also provide the critical payload technology once it's up there.
Vertical integration. It locks in customers for the entire mission lifecycle.
And this is why their competitive moat is so much wider than just saying they have the Electron rocket.
Exactly. They offer a full, integrated space platform. The proven Electron for the small to medium satellites, and the developing Neutron rocket for the heavier payloads,
Covering both ends of the market.
positioning them perfectly. And that vertically integrated approach where they design the hardware and launch it, that has to be what's driving that massive order book.
It is. The backlog is enormous. It's standing at $1.096 billion at the end of the quarter.
That is just tremendous revenue visibility. Very few companies in this sector can say that.
But a billion-dollar backlog doesn't mean much if it takes 10 years to actually become revenue. What about the conversion rate?
That's the real insight. It's not just the total number. We know that roughly 57% of that billion-dollar backlog is expected to convert into realized revenue within the next 12 months.
57% in 1 year. That's an incredibly high conversion rate.
It is. It secures their financial position well into 2026. This isn't just theory. It's booked business ready to go.
And to connect back to our point on those amazing gross margins, where is the money in that backlog coming from?
And that's the punchline. About 60% of that massive backlog is tied directly to their high-margin space systems segment.
So not the launches.
The launches are part of it,
Mm-hmm.
but the profit engine is increasingly becoming the systems, the design, manufacturing, and operation of the satellite components. It's stickier and much higher margin.
And that seems to be paying off already, considering they also locked in a record 17 Electron launch contracts in Q3 alone.
Right. It's not one or the other. It's simultaneous growth.
Okay, so shifting gears a bit, let's look at how the market is responding to all of this. What does the technical picture look like?
The technical picture is extremely bullish right now. The stock has shown just remarkable resilience.
It really has. I mean, earlier this year, it bottomed out near $15, but since all this good news, it's rebounded sharply to the low 40s.
It's more than doubled off the 52-week low. That's not just regular volatility. That signals a real structural shift in how the market sees the company.
A clear trend reversal.
A very clear one. Technically, the shares are trading above both the 50-day and, critically, the 200-day moving averages. For any technical analyst, crossing those long-term indicators is, a classic signal that momentum has shifted from bearish to bullish.
So based on that, it looks like there's some pretty strong support holding around that $39 to $41 level. But what's the upside look like?
If positive catalysts emerge, like a big contract win or major neutron progress, we could easily see the stock test that $49 to $54 range. The floor seems to be rising, but operational news will set the new ceiling.
And it seems like the big institutions agree. We saw BlackRock disclose an increased stake back in October.
Absolutely. Institutional buying is the best form of validation, and their ownership isn't just steady, it's quietly increasing.
Which is why those upcoming 13F filings are so important.
Right. The December 31st filings will be critical to watch. We'll get a much clearer picture of which major funds were buying in Q4 after that strong earnings beat. And speaking of that beat, the Q3 results really drove this positive sentiment. They crushed the consensus estimates on both revenue and EPS.
Which led to that immediate 7% pop post-earnings and a bunch of analyst upgrades. You deliver on the promise, the market rewards you.
So that's the story up to now. But investors are buying the future. So let's look ahead. What are the key dates and, I guess, the speculative events we should be watching?
Okay, the biggest hard date we have is the Q4 2025 earnings release. That's tentatively set for January 20th, 2026.
And why is this specific report so crucial?
Because it's the first time management will really be expected to show tangible progress on the GS integration. Investors will want to see that the acquisition is delivering on revenue as promised.
So they need to show the strategy is working.
Exactly. And we'll also need to see that the high conversion rate of the backlog is actually translating into sequential revenue growth. Okay, now for the exciting part, the market chatter. What are the whispers telling us?
Well, there is significant chatter about a potentially major government contract win. The industry is buzzing that Rocket Lab is a front runner for a huge multi-launch deal.
Likely for national security payloads.
That's the speculation. And if they land that, a contract of that size could be worth half a year's revenue. It would instantly boost the stock in the backlog.
And beyond government contracts, the future valuation really all hinges on Neutron.
It all comes down to Neutron. They're aiming for a 2026 or 2027 first flight, but we're hearing rumors about some significant technical announcements coming sooner.
Like what?
Industry speculation suggests a possible announcement of major upgrades or hitting a substantial technical milestone. Any concrete positive news about Neutron's readiness? especially about its reusability, would be a massive bullish trigger.
Right, because the market is pricing in the success of Neutron. Any hiccup is a problem, but any acceleration is a huge win.
Exactly. And we're also hearing more strategic rumors, aren't we? Something about accessing new capital pools.
We are. There's been unverified talk about a potential dual listing on a European exchange.
And the strategy there would be pretty clear. Access deeper EU capital markets, broaden the investor base, and maybe rely a bit less on U.S. market volatility. Makes a lot of sense.
And just to wrap up the timeline, there are a few smaller things, like ETF rebalancing at the end of November and a minor board change.
Right. Director Matt Ashiko resigned, but the company made it very clear it was not due to any operational or strategic disagreement. These things are normal.
Okay, so that brings us to the counterpoint. We've painted a very bullish picture, but what are the key risks that could derail all this?
The primary risk, and it always hangs over these high-growth aerospace firms, is the lack of sustainable profitability.
They're still burning cash.
They're still burning cash. The losses are narrowing, but they have massive R&D expenses to scale up, especially for Neutron. That war chest is large, but it's not infinite.
And that ties directly into what I think is the single biggest threat here, execution risk.
The execution risk on Neutron is non-trivial. Building reliable, reusable, high-capacity rockets is one of the hardest engineering challenges there is.
And delays are common in aerospace.
Delays are common. If they hit technical setbacks that force major redesigns, it dramatically impacts future growth projections. The current stock price assumes they will execute successfully. This is the ultimate prove-it moment.
And then there's just general market risk. Aerospace stocks are famously high beta.
Right. Rocket Lab's beta is around 2.17. That means for every 1% move in the broader market, the stock tends to move over 2%.
So it's very exposed to swings in investor risk appetite.
Very exposed. Though it is worth noting, they have outperformed their major peers year to date, which shows some genuine relative strength.
So we've come full circle. We have this spectacular growth, a widening moat, a huge liquidity buffer, all balanced against some really serious execution risk.
That's the fundamental trade-off investors are making. It's growth versus volatility.
You're buying into the vision of them becoming this vertically integrated leader, not just a small launch provider.
You are. And you're accepting the temporary non-profitability and the high volatility as the price of admission for potential market leadership in what could be a multi-trillion-dollar sector.
The foundation looks solid with the high margins and the backlog. But the next stage of growth is all about Neutron.
The integration of Geost and the successful execution of the Neutron program. Those are really the two metrics that will determine whether this impressive growth trajectory continues to pay off for investors over the next year.